Do large check writers or funds get better deals than individual investors? It is a question I hear often, and the assumption is usually yes, they do, because they have more capital, better access, perhaps even stronger relationship. Naturally, they must be getting better opportunities. But the reality is a bit more nuanced. Let me explain. Large check writers or funds do have certain advantages. For one, they can write larger checks, they can move relatively quickly because they have the capital, they do not have to raise it, and they're often viewed as more reliable capital. And that matters because in a competitive environment, certainty of execution is extremely valuable. Sellers and sponsors want to know that a deal will close. So, some large check writers get earlier access or preferred allocations, but that does not automatically mean better returns. In fact, sometimes it is the opposite because when you have more capital chasing deals, you often see pricing become more aggressive. And when pricing becomes aggressive, returns compress. So, larger investors may win the deal, but not necessarily win on performance. Now, here is where it gets interesting. Individual investors or smaller groups can sometimes be more selective. They're not forced to deploy large amounts of capital. They can pass on deals that do not meet their criteria 100%. They can wait, and that optionality can be an advantage. The real question is not who gets better deals, it is who is more disciplined. Because access without discipline can lead to overpaying, and discipline without access can limit opportunity. The best investors understand how to balance both. They build relationships to see opportunities and have a healthy pipeline, but they maintain the discipline to say no. Now, there's one more layer to this that I wanted to add, and that is structure. Large funds may be able to negotiate better terms in many cases. Fees, governance rights, co invest opportunities. Again, that depends on the situation and the operator. These special terms are not always guaranteed. So here's how I would think about it. Do not assume that bigger capital equals better outcomes and better returns, especially if they haven't been realized yet. Instead, focus on the quality of the deal, the strength of the operator, and the discipline in underwriting. Because at the end of the day, returns are driven by decisions and execution, not just access. And protecting your capital is less about being in the room and more about what you do once you're there.